Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, did you enjoy a little luck of the Irish yesterday? Maybe a little green beer. Maybe you pinched your friend who wasn't wearing green. You know, with a name like Maharrey, I'm pretty much required by some kind of international law to acknowledge St. Patrick's Day. And so I am, even if a day late. Here's a fun little fact. Did you know that St. Patrick wasn't Irish? True story. He was actually British. Patrick was captured as a youth by Irish raiders and spent a number of years basically as a slave in Ireland, but later managed to escape. And after becoming a priest and then a bishop in England, he felt called to return to Ireland to proclaim the gospel to his captors. It's a pretty cool story. More relevant to this show, gold serves as a prop in one of Ireland's better known myths, at least better known here in the United States, and that's of the leprechaun. I actually wrote an article about this over at moneymetals.com/news that was published yesterday, and you can head over there and read it if you're interested. But I do think the central story around leprechauns is worth noting here on the podcast. So for a little background, you need to know that leprechauns are actually cobblers. Yes, they're tiny little shoemakers. And in most Irish folklore, leprechauns are masters of deception. And that's really just kind of a nice way of saying they're little liars. They're extremely hard to find. I've never found one, so we can confirm that. However, humans supposedly do occasionally catch leprechauns. And even then, the mythical creatures typically outsmart their captors and often use human greed to their advantage. I thought I would share one of the stories associated with these little critters. A poor farmer and his wife pulled their last carrot out of the ground and found a leprechaun clinging to the root. The captured creature offered to grant the couple one wish if they would set him free. But there was quickly a problem. The couple couldn't agree on what to wish for. So they started to wish for everything. Like they were going back and forth with each other. They thought about a new tools, maybe, or a new house, maybe some jewelry. Meanwhile, the leprechaun was dismayed by their greed, and he told the couple they could have all they wished for and more if they could find his pot of gold at the end of the rainbow. The leprechaun left with a wink, and the couple spent the rest of their days chasing the end of the rainbow. So yeah, the moral of the story is pretty clear there, isn't it? Be careful of greed and searching for things that you'll never find, because the tricky thing about the rainbow is there's not really an end. So the good news is you don't have to go out and find the end of a rainbow to get some gold, because if you did, you'd never have any gold. But we have plenty of gold and silver right here at Money Metals, and we promise no trickery. We won't lie to you. We won't trick you. In fact, in the spirit of the St. Patrick's Day season, we have beautiful gold and silver rounds that honor Celtic spirituality and Irish heritage. Don't even have to find a rainbow. These beautiful rounds are minted by Terra Coins in Ireland. I interviewed Mark O'Byrne, who is the founder of Terra Coins, on our Friday Market Watch podcast a couple of weeks ago. You can check that out. But the rounds feature the Tree of Life and the Irish Harp, which are both honoring Celtic spirituality and Irish heritage. So you can check those out. You can go to moneymetals.com, or I will just link to them on the show notes page, or you can just call 800-800-1865 and talk to a Money Metals precious metals specialist. But definitely worth having. Okay, I suppose we should probably delve into the topic of the week. Where can you hide in the midst of geopolitical and economic chaos? Before we get into the subject, though, I do want to thank you for listening to the Midweek Memo. I say this every week, but I mean it from the bottom of my heart. I really appreciate it. I know there's all kinds of things that you can listen to, lots of ways to spend your time, so it means a lot that you download and listen to this podcast every week. If you want to help us out and help us grow the show, you can do that by going to wherever you listen to the podcast and writing us a nice review. Give us those thumbs up or those 5 stars, 4 stars if you're not quite, if we're not perfect, but 4 or 5 stars. But we really, in all seriousness, we really would appreciate that help. It boosts the algorithm and it will show the show to more people. You can also share the show on your own social media feeds if you are so willing, and let your friends know we're here. So, thank you very much. And let's look at where to hide. It seems like gold is the last safe haven standing. And actually, I think I did a podcast with this title a while back. So this isn't anything new, but it has been reaffirmed by the way the markets have moved in the early stages of this Iran war. Now, while one would expect U.S. Treasuries to get a boost from the geopolitical uncertainty inherent in war, after all, Treasuries have been long considered a safe haven. They've not gotten that boost at all. In fact, the 10-year Treasury yield has jumped from 3.96% the day before the U.S. and Israel launched their attack to 4.20% as of yesterday afternoon when I was doing show prep. Now, this isn't a huge surge in the yield, but it certainly doesn't scream that everybody wants to buy treasuries. And keep in mind, the price of a bond is inversely correlated with the yield. So when demand falls, the price drops and the yield goes up. So you can think of it this way. It's trying to entice people to buy these bonds. So the price is going to drop, make them cheaper. The yield increases, meaning you get more return on that investment. So that's what's happening. So when we see yields going up, it is signaling lackluster demand for U.S. bonds. So people just don't really want U.S. debt right now, despite the fact that we're in a situation that would normally drive safe haven investing. Meanwhile, gold was the go-to safe haven when the news of the war hit the presses. The yellow metal surged above $5,400 an ounce before giving back most of those gains just a few days into the hostilities. Now, I need to note here that at this point, there doesn't seem to be a lot of risk-on sentiment out there at all. Nobody's really piling into safe havens, and the stock market seems to have steadied. Oil has generally stayed below $100 per barrel, apart from some headline-driven spikes, and gold has traded sideways throughout the conflict once we got past that initial surge and correction. So it's kind of wiggling up and down depending on the headlines. In general, we've seen gold kind of range-bound for quite a while, between about $5,000 and $5,200 an ounce. So still, you'd think that a war would give bonds some kind of boost, right? Nope, not at all. So why aren't U.S. Treasuries catching the traditional expected safe haven bid? I think there are 2 reasons, and one is specific to the dynamics of this particular war, and the other is a more fundamental shift away from dollar assets. So, Forest for the Trees founder and respected macroeconomic analyst Luke Groman told Kitco News that the problems in the Treasury market can be traced to the outsized role oil is playing in the conflict with Iran. And he said the sudden oil shock exposes the limitations of a global financial system built on dollars. The fact that the world's oil market runs on dollars means that every country in the world depends on the U.S. currency. Global investors hold around $27 trillion in dollar-denominated assets, including U.S. Treasuries. And I've talked about this quite often, the fact that the world needs dollars, the fact that the dollar is the reserve currency, the fact that the dollar is the petrodollar. That means that people need dollars, and it allows the U.S. to create a lot more dollars than it otherwise could. In other words, the dollar's privilege as being the petrodollar and the reserve currency allows the federal government to inflate the currency far more than it would. This basically supports U.S. empire building. It supports the warfare and the welfare state. The U.S. government could not spend as much money as it does without the dollar being the reserve currency, because we would have such a massive inflation problem. That's the problem that we're looking at as the world is beginning to kind of shy away from the dollar. So Groman said that with oil prices surging, foreign nations are kind of stuck between a rock and a hard place. Quote, they have to have energy, they have to have food, they have to have these commodities. And so they will sell dollar assets, starting with treasuries, because they're the deepest and most liquid, to essentially buy oil. So that makes sense. It makes sense to me. We've kind of seen this phenomenon when you have very sharp, quick drops in the stock market. You'll often see gold sell off as well, because people will use the liquidity of gold to raise cash to cover their short positions. So we're kind of seeing the same thing according to Groman. We're seeing people selling treasuries for that liquidity so that they can buy oil as that oil price surges with the war going on. While we're on the subject of oil, I need to reiterate something. Rising oil prices do not cause inflation, at least not inflation in the sense that it used to be defined by economists. Yes, higher energy prices can cause the cost of a lot of other things to go up, because energy factors into just about everything. So an oil price shock could cause price inflation. But true inflation, which is a rise in the general price level, is not caused by price shocks. Now, again, I'm not saying rising oil prices don't cause problems in the broader economy. In fact, I think a prolonged war could be the pin that pops the bubble and sends this debt-riddled economy into a recession and begins the cleansing and the correction that we still haven't gotten after the monetary malfeasance of the Great Recession and then the COVID era. Right? We've never cleansed all of that inflation out of the system. We've never dealt with the malinvestments in the economy. In fact, the COVID era allowed the Federal Reserve to kick the bust can down the road because it was able to inject even more money into the system. So we're due for a recession, and this could be the pin. But whatever problems oil prices might cause, that's not inflation properly defined. Inflation is the increase of money and credit. It's a rising money supply. Rising consumer prices is one symptom of this monetary inflation. So please, for the love of all that is good, don't let the government people and their mouthpieces convince you that rising oil prices are causing inflation. What they're doing is they're hiding the real cause, which is money creation driven by loose monetary policy, which, quite frankly, is only going to get looser because of this war. So anyway, as I have discussed in prior episodes, wars historically have not tended to have a long-term impact on gold prices, at least not in the modern era. And I'm not going to rehash that. I talked about it a couple of shows back. However, the war is playing out on a larger game board, so to speak, right? Treasuries have been struggling for months because a lot of countries simply don't want any more exposure to U.S. fiscal malfeasance. The national debt has surged to $38.9 trillion. We're on the doorstep of $39 trillion debt. Meanwhile, the federal government has shown zero interest in reining in the spending. On top of that, it is blowing through an additional $1 billion per day, roughly, to fight the war. And that's on top of already out of control spending. We got the February Treasury statement the other day. You'll be shocked to learn that there was yet another big budget deficit. The Trump administration spent $307.5 billion more than it took in last month. This was almost identical to the February 2025 deficit, despite a big increase of revenue thanks to tariffs. The February shortfall drove the fiscal 2026 budget deficit to over $1 trillion just 5 months in. So for context, the biggest deficit ever run by the Obama administration was $1.41 trillion back in 2009. So it's important to understand this is not a revenue problem, right? So don't let the Democrats convince you that we need tax hikes to pay for all of this spending. No. So far in fiscal 2026, the federal government has collected $1.89 trillion in revenue. That's a 10.8% increase over the same period in fiscal 2025. There's plenty of money. Now, of course, some of that boost is thanks to tariffs. So far in this fiscal year, the federal government has collected $151 billion in customs duties. That's up about 294% from a year earlier. So you've heard about how tariffs are boosting federal revenue. That's true, but it's not cutting the spending. And of course, the tariff gravy train may be coming to an end. After averaging around $30 billion per month at the peak, tariff collection dipped to $26.6 billion in February. And there's been this slight downward trend since about December. And of course, it remains unclear how the recent Supreme Court opinion declaring Trump's unilateral tariffs unconstitutional will impact tariff collections in the future. But I'm going to guess it's probably not going to be a positive. In other words, what I'm saying here is I think we're probably at the peak of tariff collecting, and we actually may see a big decrease in tariffs as we move forward. But the real problem is on the spending side of the ledger. The government blew through another $620.62 billion last month. That was up 2.8% over the same period last year. In total, Uncle Sam has spent $3.1 trillion through the first 5 months of fiscal 2026. That's up about 2% over the same period in fiscal 2025. Now, a 2% increase in spending might not sound significant. I mean, it's basically inflation, right? But weren't we told there would be spending cuts? Instead, we got a war. Anyway, would you want to lend your drunk uncle who has maxed out his credit cards and can't quit spending more money? If not, you understand how the rest of the world feels about Uncle Sam. So it's not surprising that many countries are anxious to minimize their exposure to the dollar. We see this reflected in accelerating de-dollarization and the fact that gold recently climbed above Treasuries as the world's biggest foreign reserve asset. When times get tough, you don't want rapidly devaluing dollars backed up by a spend-happy U.S. government. You want real money, gold, backed by nobody. That's why central banks are buying gold. So the war, if anything, is going to exacerbate this. And you have to remember that the war is playing out in this context. What happens with the war is not the only thing on the radar for gold. All of the things that we've been talking about for months, the weaponization of the dollar, de-dollarization, the debt black hole, all of those things are still in play. I mentioned the weaponization of the dollars. A lot of countries are becoming even more concerned. Of course, they were already worried about the weaponization of the dollar, having witnessed how the U.S. handled the sanctioning of Russia after its invasion of Ukraine. And we can agree or disagree about whether or not these sanctions are appropriate, but it's important to understand that the rest of the world is watching. And in an article that was published by the Atlantic Council, and this was before the Iran war, the authors pointed out that central banks that are worried about getting sanctioned or want to protect themselves from a potential global financial crisis, or both, have been stacking up gold at record levels. Now, make no mistake, and I've already alluded to this is a big problem for the U.S. because it depends on the global demand for dollars, supported by the dollar's reserve status to underpin the massive government and all of the spending that it has to do to stay massive. The only reason Uncle Sam can borrow, spend, and run massive budget deficits to the extent that it does is the dollar's role as the world's reserve currency. It creates a built-in global demand for dollars and dollar-denominated assets. This absorbs the Federal Reserve's money creation, helps maintain dollar strength despite the Federal Reserve's inflationary policies. If the world wants or needs fewer dollars, well, where are they going to go? They're going to come right back here to the United States, causing a dollar glut. This will increase inflationary pressure domestically as the value of the U.S. currency further depreciates. In the worst case scenario, the dollar could collapse completely, leading to hyperinflation. Now, I don't think that's going to happen, but I do think that people should be more concerned than they are about the de-dollarization trend, because I don't think it's going to I don't think it's going to require a lot of de-dollarization for the U.S. to begin to feel the impacts. In fact, we might be feeling the impacts already. When you have a situation where we're in the middle of a war with all of this geopolitical uncertainty and you've got bonds selling off, that's telling you something. Groman pointed out a sobering reality. He said, Iran doesn't have to beat the U.S. military if it even could, which I doubt. All it has to beat is the bond market. So it's going to be interesting to see how the war plays out. But I think one thing is becoming pretty clear. Gold is the last safe haven standing. It is the place to hide when there is geopolitical uncertainty. It's certainly the place to hide when we have inflation and massive levels of spending, which of course are all inherent in a war. And, before I go, I want to emphasize that while the war right now is getting most of the attention, and it's really driving the markets day to day, right? It's playing out in a broader context, as I've already said. There are a lot of things going on in the economy that we need to watch along with the war, like the constant government spending, right? Things that are happening in the stock market, the debt black hole, all of these things, even as the war lingers on. Don't take your eyes off of these underlying fundamentals. And as I've talked about already, war itself typically hasn't been a big factor driving the gold market. One of the big banks is taking the same position, and I want to go through just some of the things that were in a recent note that was published by UBS, which is a large bank that is based in Switzerland. They still expect gold to gain about 20% this year from its current price. In the note, the analyst noted that gold has not been able to break through resistance at $5,200, even with the geopolitical uncertainty of the Iran war, calling it, quote, a contrast to its 65% rise last year when heightened geopolitical risks served as a tailwind amid fundamental drivers such as lower real interest rates and debt concerns. However, the UBS analyst noted that gold seems to be following a similar wartime pattern, with many investors using gold as a source of liquidity to manage stock and commodity price swings. Quote, its latest performance mirrors historical behavior during such events, where investors seek liquidity and consider alternatives like energy assets. So they're alluding to what I mentioned earlier, and the same thing is happening in bonds, but to a lesser extent with gold. People use their gold holdings as a source of liquidity when they need to cover shorts, when they need to pivot. Gold is kind of the pile of money that they can dive into. But looking beyond the short-term impacts of the war, UBS analysts remain bullish on gold, forecasting that the price will rise to between $5,900 and $6,200 by the end of the year, quote, as the key drivers underpinning its strong rally remain in place. Quote, given the macroeconomic and political uncertainties beyond the risks arising from the U.S. Iran conflict, we continue to hold a positive view on gold and believe that the yellow metal remains an effective portfolio diversifier. So they're basically saying the same thing that I am. War matters, but there's a lot of uncertainty and risk beyond this that we need to pay attention to. The UBS analyst pointed out that investment demand remains robust, even as the metal trades in kind of a range-bound situation since the big sell-off in January. Quote, while ETF investors trimmed their gold holdings slightly earlier this month, their positions have shown greater stability of late, and hedge funds have modestly boosted their net positioning in gold. We believe total gold demand is likely to stay strong, supported by continued central bank purchases, rising investment activity, as well as the structural growth of demand for gold jewelry amid higher income in Asia. Analysts at the Swiss bank add that the factors driving the bull market before the war remain in place and may be exacerbated by the ongoing conflict. And this is a theme that I've really been trying to hammer on. And I was glad to see that I'm not alone in thinking this. The UBS analyst said gold is more of a hedge against the wider impact of conflicts rather than direct wartime threats. Gold primarily insulates against monetary risks like currency devaluation, rising deficits, and economic slowdowns, which can result from geopolitical conflict. So again, the war may well exacerbate some of these trends that were already driving gold higher. The UBS note cautioned that investors could see some short-term pressure on gold prices as the war progresses. Quote, in the short term, higher energy prices and inflation worries have led to a stronger U.S. dollar and concerns over potential rate hikes. Both are negative for gold prices. This is one of those things that absolutely drove me crazy a few years ago, right? Every time that we would get any indication that inflation was continuing to run hot, we would see gold drop. People would sell their inflation risk or their inflation hedge when they heard that inflation was going up because they were worried that the Fed might raise interest rates. It's crazy. If you have inflation, you want your inflation hedge, right? The UBS analysts said they don't think central banks are going to be inclined to hike rates as the war goes on. Quote, but we expect central banks to be watchful of inflation risks without making knee-jerk policy rate hikes. And in fact, the Federal Reserve, and I've been talking about this for over a year now, it's caught in a catch-22, where it should hold rates higher for longer to battle rising inflation, war or no war, but it can't because the economy is being warped by a giant debt black hole. In fact, further monetary easing seems far more likely than interest rate hikes. And the UBS analysts agree with that. They said, quote, a weaker U.S. dollar and lower U.S. real interest rates are supportive of gold, and we believe this macro environment remains intact as the Federal Reserve has more to go in its easing cycle. Despite stronger recent jobs data, which is all being revised down every day, side note, and some hawkish elements in the latest FOMC minutes, easing inflation pressure in the coming months and a more dovish personnel profile at the Fed later this year should support additional rate cuts. We expect 2 25 basis point rate reductions by the end of September. So inflation or no inflation, they're going to cut rates because they have to, because we have a debt black hole. Furthermore, James Madison wisely pointed out that war is the parent of armies, and from these proceed debts and taxes. The federal government already has a spending problem, as already discussed, and this war won't help. In fact, we can likely expect bigger deficits and even more quickly ballooning national debt if the war lingers on. Again, UBS analysts agree with this, noting that the longer the war drags on, the greater the risk of negative economic impacts. So, when you boil it all down, we're talking about an inflationary scenario, as the Fed will likely have to take steps to monetize the wartime debt, and that means even more money creation, which means ultimately more price inflation. The UBS analyst emphasized that gold, quote, stands out as a hedge against inflation. Quote, according to the Global Investment Returns Yearbook, the real returns of gold and commodities since 1900 have positive correlations to inflation. So, the war could also exacerbate ongoing de-dollarization as other nations worry about being exposed to this fiscal malfeasance. Quote, we expect structural trends such as elevated government debt, as well as central banks and global investors' efforts to diversify away from the greenback to support gold's long-term outlook. So the bottom line here, and I hammer this every week, you can pretty much expect me to say this every show. Inflation is the plan. Governments devalue fiat currencies on purpose. It is part of their lifeblood. They have to do it. It's the way you can have big government without burdening the citizens with overt taxes, right? You'll accept inflation a lot longer than you'll accept an actual tax. Now, it's the same impact on you, right? You're losing purchasing power. You're losing your ability to buy and spend and make your life better because you're sending your money to the federal government. Well, with inflation, you're not really sending your money to the federal government, but they're just whittling away your purchasing power and leaving you with less. So you want to have real money, right? You want to hold gold and silver because it holds its value over time. That, to to me, as an investor, is gold's primary role. It's real money. I don't want to save in fiat currency that is being devalued on purpose every single day. So if you want to get some gold and silver, now might be a good time. We're seeing some price dips from time to time. These are buying opportunities. And right now, gold's kind of hovering around $5,000 an ounce or so. If we're talking $6,000 gold by the end of the year, like the UBS folks say, well, there you go. So now's a good time to give us a call at Money Metals. 800-800-1865. You can talk to a Money Metals precious metals specialist. Ask them questions. They can help you figure out how precious metals might fit into your investment portfolio, what products might work best for you. These folks are great. They love to answer your questions, so give them a call. Make use of their insight and knowledge. If you don't want to talk on the phone, I get that. A lot of people don't these days. You can go to moneymetals.com. You can chat with a precious metal specialist online, or you can just go to moneymetals.com and pick out whatever you want. You can order right online. You want some American Gold Eagles, you can buy those. We'll ship them out to you, or you can store your precious metals in our state-of-the-art bullion depository in beautiful Eagle, Idaho. But do it today, right? The time to protect your wealth is now. The government's not going to stop devaluing your dollars. Your dollar's not going to be worth more next month than it is today, because they're going to keep making more of them. It's almost like a guarantee. So act today. So that's a wrap for this episode of the Money Metals Midweek Memo. You can get more information on everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and join our email list. There's 1 million people plus on there. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform. And when you do, you'll also be able to tune into our Market Wrap podcast that runs every Friday, where you will hear interesting interviews between yours truly and interesting people from the world of gold, silver, economics, and investing. Thank you so much for listening to the show today. I hope you have a fantastic rest of your week, and I will be back here again next Wednesday.